Hey guys, welcome to the channel Market Uncharted. In today's video we continue to explore the bond market and bond investments, and we'll start with the government bonds. So basically government bonds are debt security issued by the government to support government spending and obligations. Developed and emerging market government bonds form a central part of a global bond market. In many cases, they function as the risk-free asset used as reference benchmark for the respective domestic currency. Sovereign bonds are the largest segment of global bond markets. In total, there are almost 20,000 central government bonds listed on Bloomberg, with a nominal value equivalent to $35 trillion. The US is by far the largest issuer, with more than $14 trillion of bonds. The US dollar is also the currency in which bonds are mostly issued, followed by the Japanese yen and the euro. Many of the government bonds denominated in minor currencies form part of a domestic bond market that is not at all causes accessible to foreign investors. While governments issue most of their bonds in their domestic currency, the most commonly used foreign currencies are the US dollar, 1 trillion, the euro, 137 billion, and the GPY. So you can see here the bond market as well. So we have two types, primary bond market and secondary bond market, and then several types as well: corporate bonds, government bonds, which we are going to explore today, municipal bonds, mortgage-backed bonds, and emerging market bonds. Most countries have several debt issue series. Foreign currency bonds are usually issued under English or US law and have a different underlying prospectus than domestic currency bonds, which are in most cases governed by local law. In domestic currency, governments usually issue bills and term debt. Bills are issued with tenors ranging between a few months and, in exceptional cases, more than 12 months to maturity. They are issued as zero bonds, discount notes, with the typical buyers being domestic banks using term as collateral for central bank borrowing. Term debt, in most cases, has a fixed coupon. Governments usually aim to maintain a liquid reference curve between 2 and 30 years. See benchmark discussion. Some governments issue 50 to 100-year bonds. Bonds can be differentiated into series. Governments regularly increase the size of their existing bonds post-initial issuance so that they are regular. New issuance can have a variety of tenors. Tapping existing bonds that are closest to the main reference tenors, 2, 5, 7, and 10 years, ensures that these remain sufficiently liquid in the secondary market. Domestic versus foreign currency ratings. While domestic currency government bonds are usually the lowest yielding benchmark asset, at least in development markets, some of the supporting factors do not apply when a government issues bonds in a foreign currency. To attract international investors, countries are incentivized to issue bonds in major currencies. If the domestic currency is less important in international trade, the domestic investor base is small, domestic interest rates are very high. This is traditionally the case for emerging market countries, but even highly rated developed countries sometimes try to diversify their investment base with the international bond program. The additional risk of issuing bonds in a foreign currency compared to domestic currency stems from a potential foreign exchange crisis, in which the government would run out of hard currency reserves, face a sharp devaluation of its domestic currency, resulting in it being unable to pay foreign currency bonds. Most of the historical emerging market sovereign default events occurred in hard currency bonds. Usually there is no cross-default clause between the two types of bonds. So again, let's make sure we understand the difference between what is corporate bonds and government bonds. What we are seeing right now is on the right side, government bonds, which are issued by central banks. They pay interests, are considered one of the safest investment options because they carry sovereign guarantees. also give less yield than corporates, because exactly the risk of default of a country is different of a risk of default of a corporate. Government bonds are also generally issued for terms ranging from 5 to 30 years. Since it's a long tenor, it loses its relevances. So for corporate bonds, basically private companies, also they pay interest on a monthly, quarterly, semi-annually and annually basis, are more risky than governments because they include market risk, credit risk and interest rate risk, but also for that reason can give higher returns to investors, and range maturities are between 1 to 25 years. So let's just take a look also on sovereign default statistics, because it happens in the past that the government simply default on their debt obligations. According to an analysis done by Moody's, the average loss for investors in sovereign bond defaults of modern history was 47% compared to par value, which is comparable to corporate defaults. This includes a wide range of recovery values of between 5% to 95%. Almost all distress exchanges include maturity extensions and most an interest rate reduction. Only about half included a nominal value haircuts. Therefore, the ratings for countries that had defaulted often stay very low post-default, as governments have resolved their imminent liquidity crisis but in many cases retain a very high debt burden. As a consequence, redefaults in the form of several subsequent distress exchanges frequently occur, and on average it took defaulted countries more than 5 years to return to international bond markets, according to Moody's. Let's start with a few examples. In Greece, the loss to investors amounted to 76% of par value using trading prices of the new bonds following the exchange. However, 1 year after the exchange, the government debt ratio remained higher than it was previously. Argentina undertook 2 exchanges of debt. In the first exchange in 2001, domestic debt worth of $64 billion resulted in a loss to investors of 83% of par value. Following the exchange, the debt ratio was 8 points higher than it was before. The second exchange took place in 2005, and the target $8 billion on foreign debt. This resulted a loss to investors of 71% of par value and ultimately lowered the debt ratio from 125% to 70%. In Russia, the picture was similar to Argentina, with the initial local currency debt exchange taking place in 1999 and a further rise in the debt ratio. This was followed by a foreign currency debt exchange that lowered the debt ratio from 99% to 60%. Losses to investors were in excess of 90% of par value after taking into account currency devaluation. A successful government debt reduction usually requires that the restructuring includes a significant haircut in the nominal value of debt and also a return to economic growth and fiscal reforms. Government debt will often increase further due to bank recapitalization costs, government support of public entities and the economy, as well as currency devaluation and economic stagnation or contraction. So thank you so much guys for watching this video. Never forget, knowledge is not power, knowledge is potential power, execution is everything. And just like the markets, we will not rest.